Today's pick number one is CMTL. Comtech Telecommunications creates and sells innovative products and services for advanced communication solutions. It targets both commercial and government markets globally, offering solutions especially useful when traditional communication infrastructures are not available, inefficient, or too costly. Comtech operates through three main segments: telecommunications transmission, RF microwave amplifiers, and mobile data communications. In the wireless equipment industry, Comtech ranks 208th out of 252, according to Zacks Investment Research. Comtech is considered oversold for several reasons, reflecting its financial performance and market sentiment. Since the beginning of 2024, its stock price has fallen dramatically. It went from $8.43 at the start of the year to $3.43, marking a 59.3% decrease. This steep drop may indicate the market is undervaluing the stock, suggesting it's oversold. The company's recent financial results reveal challenges. It reported a loss of 15 cents per share in its latest quarterly earnings, which, while better than the anticipated 22 cents loss per share, still indicates struggles. Its revenue was $116,760,000, down 13.7% from the same quarter the previous year. Analysts have varying opinions on Comtech, generally advising to hold the stock. Price targets range from $7.50 to $18.25, with an average target of $12.25. This indicates a considerable potential increase from its current price. The company's financial health, including a negative earnings per share of 86 cents for the last fiscal year and net margins of minus 3.02%, adds complexity to its valuation. Nonetheless, these elements also suggest the stock might be oversold, as its price drop could be an overreaction to these challenges. Furthermore, Comtech has secured strategic investments and contracts that could improve its long-term prospects, including a $48 million contract extension for next-generation 911 services and a $544 million U.S. Army contract. These developments could mean the stock's current low valuation doesn't fully recognize its future growth opportunities. To sum up, the significant decrease in Comtech Telecommunications Corp's stock price, along with its recent earnings shortfall but potential for future contracts and investments, supports the view that the stock is oversold. Today's pick number two is SMMT. Summit Therapeutics is in the business of finding and creating drugs for treating Duchenne muscular dystrophy, a serious muscle wasting disease, and infections caused by the bacteria C. difficile. The company's headquarters are in Abingdon, in the United Kingdom. In the world of medical drug companies, Summit Therapeutics is part of an industry that ranks 98 out of 252, according to Zacks Investment Research. Recently, Summit Therapeutics has seen its stock price go up and down quite a bit. In the latest trading sessions, the stock dropped by 11.79%. Looking at the company's finances can give us some clues as to why the stock might be seen as oversold. When we dive into the numbers, the situation appears tough. Summit reported yearly sales of $700,000, which is small compared to a net loss of around $614.93 million. The pre-tax margin is an incredibly negative 271,685%. Both return on equity and return on assets are deeply in the red at negative 87.45% and negative 41.17%, respectively. These stats show the company's financial difficulties, including a high debt-to-equity ratio of 1.29. However, it does have a strong current and quick ratio, suggesting it can cover short-term liabilities. Looking at how the market values the company, the numbers are also concerning. The price-to-sales ratio is 3,638.82, and the price-to-book value is 33. This suggests investors are cautious about the stock's value versus its financial results and assets. It's also important to mention the company's recent actions and developments. For instance, big investors like the Vanguard Group Inc., Goldman Sachs Group Inc., and Virtue Financial LLC have bought shares, possibly seeing some promise in the long term. Plus, The stock has increased from its value at the start of 2024, showing it can be a volatile but possibly beneficial investment for those ready to face the risks. Given all this, the recent selling of the stock, making it seem oversold, could be more about investors reacting to the company's financial state and overall market trends rather than a clear judgment of its future success. Today's pick number 3 is MEI. Method Electronics Incorporated stands as a worldwide leader in the creation of electronic components and subsystems. With its designs, the company produces and sells devices that make use of electrical, electronic, wireless, sensing, and optical technologies. You can find Method's components across various key sectors like automotive, appliances, communications, aerospace, rail, and other transport industries, as well as in consumer and industrial equipment. Method Electronics within the electronics connectors industry, which is ranked 91 out of 252 industries by Zacks Investment Research. Lately, Method Electronics Incorporated MEI has hit a rough patch, which has made some market watchers label its stock as oversold. Let's explore a few reasons why this might be the case. Firstly, there's been an earnings miss and net loss. Method Electronics reported a net loss of $11.6 million, or 33 cents per diluted share, for the third quarter of fiscal year 2024. This outcome fell significantly short of expectations, missing the consensus estimate by 40 cents. Furthermore, the company's net sales for the quarter were $259.5 million, also below analyst predictions. Then, we've seen a decline in stock performance. The stock's price has plummeted by 45.7%, now hovering around $12.35. This is a sharp fall from its 52-week high of $46.58. Another concern is the negative net margins and low return on equity. The company's profitability struggles are evident, with a negative net margin of minus 5.09% and a very low return on equity of 0.07%. Despite these financial hurdles, Method Electronics has decided to continue its dividend payments, declaring a quarterly dividend of 14 cents per share, payable on April 26, 2024. This decision could be seen as an effort to keep shareholders' confidence during difficult times. However, it also sparks debate over the company's resource distribution, given its current financial situation. With these factors in mind, investors and analysts are keeping a keen eye on Method Electronics. Currently, the stock holds a consensus rating of hold among analysts, indicating a cautious stance towards buying more shares or selling existing ones. In summary, the mix of missed earnings, a significant stock price drop, and financial challenges suggests Method Electronics is navigating through tough times. While the dividend declaration might offer some relief to shareholders, the underlying financial and operational issues indicate a turbulent period ahead. Investors are encouraged to monitor the company's future earnings reports and management strategies closely. Today's pick number 4 is CABA. Cabaletta Bio is a company working on cutting-edge health solutions. They're in the business of creating specialized therapies aimed at autoimmune diseases. Their main projects include several innovative therapies that are currently undergoing tests. You'll find Cabaletta Bio's headquarters in Philadelphia, United States. Cabaletta Bio operates within the medical, biomedical, and genetics industry, ranked 71st out of 252 industries by Zacks Investment Research. But why do people think Cabaletta Bio's stock is oversold? Let's dive into the reasons by looking at recent events and the overall mood in the market. First, the stock's recent journey has been a roller coaster, showing significant drops. This suggests that the market is reacting strongly to short-term news or following a trend that's affecting all biotech stocks. Next, there's talk about the company's upcoming earnings report. With investors uncertain about what the report will reveal, many are choosing to sell their shares early, preferring caution over potential surprises. Cabaletta Bio's participation in healthcare conferences is a mixed blessing. While these events give the company a chance to highlight its work and attract new investors, they also put it under a microscope, leading to speculative trading. Big names like Citigroup Inc. and the Swiss National Bank have shown faith in Cabaletta Bio by investing in it. This kind of backing boosts confidence but also sets high expectations, making any small misstep seem like a big deal. Analysts are generally optimistic about Cabaletta Bio, labeling it a buy. Social media too buzzes with positive vibes, yet such high hopes can make the stock more sensitive to any news, good or bad. Biotech is a field known for its ups and downs. A company's value can swing wildly based on clinical trial results, regulatory decisions, or the mood of the market. Any negative buzz can trigger a sell off, even for firms with solid foundations like Cabaletta Bio. Social media chatter and trader sentiment, especially anticipation around company milestones or regulatory approvals, create a narrative of hope. However, this optimism can quickly fade if expectations aren't met or if the broader market takes a downturn. Considering all these points, it seems Cabaletta Bio's label as oversold comes from a mix of cautious trading ahead of major news, the impact of recent big investments, and the usual twists and turns of the biotech market. Today's pick number 5 is STRO. Sutro Biopharma develops and manufactures pharmaceutical products focusing on antibody drug conjugate and multi-specific antibody-based therapeutics for cancer therapy. Its main products in development are STRO-001 and STRO-002, which are currently in clinical stages. The company is located in South San Francisco, California, operating in the medical, biomedical, and genetics industry. Sutro Biopharma is part of a sector ranked 90 out of 252 by Zacks Investment Research. The stock has shown fluctuations recently. The last reported closing price was $3.55, marking a decline of 9.21%. This change is within the stock's 52-week range of $2.01 to $6.11, with a current market capitalization of approximately $216.38 million. Several reasons suggest why Sutro Biopharma's stock might be considered oversold. 1. Clinical and financial updates. There have been no recent negative reports that could significantly impact the stock's value. The company continues its work on developing antibody drug conjugates targeting various cancers, with ongoing trials for products like STRO-001 and STRO-002. 2. Investor sentiment and market movements. The stock's performance reflects broader market trends and investor reactions to developments within the biotech sector. The company's focus on innovative cancer treatments remains a key strategy. 3. Analyst ratings and future outlook. Despite the lack of recent specific news, the inherent volatility of biotech stocks often relates to trial outcomes, regulatory updates, and market sentiment. Upcoming investor conferences and the potential of its Luvelta product for multiple cancer types are part of its efforts to engage with investors and stakeholders. Investors are advised to watch for upcoming earnings announcements, new clinical trial data, and strategic updates from the company, as these could significantly affect stock performance. An earnings announcement is expected between March 28, 2024 and April 1, 2024, which could offer further insights into the company's progress and future direction. In conclusion, while the current sentiment around Sutro Biopharma's stock might reflect concerns regarding its valuation or challenges within the broader sector, the company's ongoing clinical programs and strategic initiatives are key considerations. Investors should keep these factors in mind alongside market trends and perform thorough due diligence to fully understand the stock's potential.